Welcome back to Insights Now. I'm David Kelly, Chief Global Strategist here at JP Morgan Asset Management. Financials, the second largest sector in the S&P 500, has had its fair share of ups and downs in recent years. As the Federal Reserve kicked off its aggressive rate hiking campaign in 2022, the yield curve inverted, loan growth slowed, and M&A activity plummeted, all of which hampered earnings growth. Then in March 2023, the failures of several US regional banks sparked concerns about the health of the banking sector and the commercial real estate market. The dust from this crisis gradually settled, which, in conjunction with Fed rate cuts and a resilient consumer, helped the sector gain over 30% in 2024. Financial deregulation is now top of mind, with the Trump administration recently naming regulatory dove Michelle Bowman as the Federal Reserve's next Vice Chair of Supervision. Prospects for increased deregulation, in addition to trends in consumer spending, will be key themes moving forward. Companies and financials tend to be represented in the value style and can be a good complement to growth exposure, especially the Magnificent Seven. Now let's get started. Laura, welcome to Insights Now.
Thank you, David. Laura, welcome. How did you end up becoming a research analyst? I'm always curious about these things, and specifically why covering financials.
Gabby, I'm excited to be here. Thank you for having me. My story actually started outside of finance back in high school, and I was hired to be a bookkeeper at a company called Women's Workout World. Now, the management team was always a little disorganized. They were always short-staffed. So instead of doing the bookkeeping, I was asked to be the aerobics instructor. Now, I'm always up for trying new things, but that was literally a step too far. So I left that company and I joined Coach. And Coach was transitioning from their leather legacy bags at that point to the interlocking Cs. And it opened up a whole new addressable market for them. So it was an early lesson for me how, quality management teams really matter, capital allocation really matters. Fast forward, I did investment banking, and then I realized I wanted to be on the buy side instead of the sell side. And I joined U.S. equities at JP Morgan, and I've been an investor here for the last 20 years. Now, financials has always been a core competency for me, and I started off as a payments analyst, and now I cover all of financials for Andy Brandon and Dave Silberman.
Very cool.
Yeah, and financials I think is really interesting because it's like a good pulse check and a good view of both the consumer and corporate. And I think it's always fun to be an expert in the business that we work in.
Yes, definitely. To me, it feels very tangible as well. And how do you do that? What's a day in the life? How are you keeping a pulse check on the consumer, on corporates, on the companies you cover?
Yeah, so as we know, we get so many emails in a day, right? So I think I try to really filter out the important emails at the beginning of the day, but I actually spend the most of my day doing primary and independent research. And I love analysis. I think you love analysis as well. And, they say that a picture is worth 1,000 words. I think a chart is worth 1,000 words.
Agreed.
And what I love to do is I like to find different sources and different data sets and compare that and correlate that to what the companies care about, such as revenue growth or credit metrics. I'll give you an example. Credit quality is really important for the credit card stocks. Now, so I'm looking at different employment metrics, such as JOLTS, such as the unemployment rate, the initial weekly jobless claims, to see which one has the best hit rate to then be able to forecast out how credit quality is going to look in the future. Now, I also spend a lot of time thinking about the longer term, how business models are changing, how capital allocation is changing. And an example here would be a few years ago, we made an investment into Morgan Stanley. At the time, Morgan Stanley's revenues were very volatile. They was very volatile investment banking revenues. But they were transitioning towards more of a reoccurring wealth management type of revenues. So we saw that transition, and it worked out for them. And now Goldman is taking the same playbook. And because we had seen that transition before, and we think Goldman has the assets in place, the management team, and the execution to carry that out, now we have a better, feel for their ability to execute on that plan. So I think it's pattern recognition. It's a lot of, shifting through the noise. And lastly, as investors in the public markets, there's always price dislocations that we're trying to take opportunities in. There's buys and sells throughout the day. So it's a little bit of both, but more focused on the longer term.
And you mentioned a few different types of companies within the financial services sector, credit cards, for example, versus banks, wealth managers. What are the main subsectors? How would you explain the financial space?
Yeah, that's an interesting question. So I think so. Financials is 25% of the Russell Value Index. 10% is banks, 10% is financial services, and 5% is insurance. So 10, 10, 5. Within banks, it's 75-25 big banks versus regional banks. And then I think about regional banks as the most basic type of business model. They do commercial lending, consumer lending. And then on top of that, the big banks are going to offer investment banking services, asset and wealth management, credit card lending. And then if we shift over to insurance, that's really, homeowners insurance, property and casualty insurance, auto insurance. And lastly, on financial services, the other 10%. I think this is my most diversified and eclectic group because it's really the ecosystem that services the flow of money, the services that touch, the movement of money and the investment of money, such as exchanges, investment banks, retail brokers, payment companies. So it's a fun and eclectic group.
And you mentioned in your day-to-day, you look at a lot of macro indicators, so close to my heart as well. What are the most relevant ones for these three different types within the financial sector?
Right, so I think we speak the same language here in that. So I think financials is a very good barometer of the health of the consumer and also of corporates. Now, on the consumer side, I care about if they're spending, the level of their spending, how they're financing their spending, whether it be from checking accounts, from savings accounts, or just from income that they're having, or if they're taking out a credit card loan. And then most importantly, I think from a bank perspective, I care about if they're paying back their loan. Because as long as the bank is underwriting it properly, they can make a profit on it. And in terms of the indicators, we have consumer spending metrics from JP Morgan internally. We have spending metrics from Bank of America, the payment networks, Visa, MasterCard. They're always giving updates. And so, for example, we are hearing that in the first quarter, I think on the whole, first quarter looks in line with expectations. January actually came out really strong. February was a little bit weaker. Now it could be from leap year, it could be from weather. And then March has actually recovered a bit. So I think on the whole, first quarter is shaping up to where expectations are. Shifting to the corporate side, I'm watching the ISM. I'm watching C&I loan growth. I'm watching credit spreads just to see how much borrowers are willing to pay for the type of borrowing needs that they have. So again, it's level of spending, how they're financing their spending, and then if they're paying off their bills.
And very cool that now we have this high-frequency alternative data that you mentioned, the Chase data, Bank of America, to get a good pulse check, right? In terms of the consumer, what are some interesting trends you're seeing besides just the cyclical position of the consumer?
Right. So I think we spend a lot of time on the institutional opportunity in terms of investments. So the institutional investment opportunity is $100 trillion. But did you know that the wealth opportunity, the private wealth opportunity, is also $100 trillion? And that over the next 20 years, $80 trillion is expected to be passed from the boomers to the next generation. So what I want to think about is, okay, where are they investing their money and what they're investing in? So our investment time frame is not 20 years, but I like to see the building blocks evolve to get to, our thesis longer term. And in terms of, where they're investing, we're looking for full service platforms that can cater to the self-directed channel, the advice-led channel, RIAs, IBDs, estate planning. So really a whole suite of products that can address the investor's need and that can grow with the investor over time. And we also want platforms that can provide different products, equities, fixed income, alternatives, and SMAs, tax aware. So a lot more full service and diversified platforms is what we look for in a stock that can address the evolving needs of the next generation. And for example, we like Schwab because they're a leader in the RIA channel, they're a leader in the self-directed channel. And we also like some of the wirehouses such as a Wells Fargo that's actually now growing advisors again. And in terms of what they're investing in, we think the next generation is actually receptive to alternative investments. And we like platforms, again, that are very diversified, that has a full suite of products, such as a Blackstone, which now has BXPE for private equity, BCRED for credit, BREIT, BX Infra now. So they have a really strong brand name, really strong long-term performance track record. And so I think that kind of satisfies not only our near-term view and also our longer-term perspectives as well.
Yes, this alternatives theme is so huge right now, the growth in the wealth investment of alternatives that we're all doing a lot of work on. Besides the health of the consumer and the investment patterns of the consumer, another hot topic, of course, is the new administration and potential and upcoming policy and regulatory changes. So how are you thinking about regulations as it comes to the financial sector?
Yeah, absolutely. I would say after 15 years of regulation that only went one way, I think we are at a point now where I think the building blocks are in place for more pragmatic regulation, transparent, and also tailored. Now, I want to emphasize that the safety and soundness of the American banking system is of the utmost importance, but I do think we can do it in a less complex way. Just to give you a mental model of how complex it is, Dodd-Frank was 2,300 pages. Basel III Endgame was 1,100 pages versus a great American novel, Moby Dick, which is only 400 pages.
Which is already long.
Exactly. So it's a lot. It's a very complex system. And as we say, personnel is policy. And I think the incoming regulators have discussed some changes to capital requirements, M&A guidelines, liquidity standards. And I'm actually hopeful that Michelle Bowman's nomination to the Vice Chair of Supervision can take place just to give some stability to the personnel side. And I think when Basel III Endgame was first announced, the banks had a really visceral reaction to it because it called for a 20% increase in capital rules without any changes to risk-taking, any changes to the business models. Bank of America CEO said he left work on July 22nd with $23 billion in excess capital. He came in the next day and he was $13 billion in the hole.
Wow.
So that is a $33 billion swing in your ability to lend back into the marketplace, and a swing in your ability to buy back stock. So I do think we are seeing the building blocks of some of these improvements in the regulatory framework. We'll get some evidence of that in the annual stress test that's expected to be announced in June. And then I do think Basel III Endgame will be more capital neutral so that a Bank of America can return that $20 billion of capital back to its shareholders.
And vocabulary matters so much, right? It always seems a bit black and white. It's regulation or no regulation, deregulation. It's a lot more nuanced than that, right? It's about visibility, forward-looking.
Absolutely. And I think it's more about transparency and having a more tailored approach. It's not a one-box-fits-all type of approach, which I think the banks are rooting for at this point.
And it sounds like there are quite a lot of tailwinds here for financials in general. But after a really good year last year for the sector, we're seeing a correction so far this year. So what's going on here, do you think?
So 24 was indeed a good year. But remember, 23 was a very challenging year. Yeah. So I think 24 was more of a catch-up in terms of where the market was paying for on the multiple side. Multiples at the end of 24 got back to long-term averages. And in fact, earnings were actually really healthy. In the fourth quarter of 24, they beat EPS on average by 10%. And I had expected 25 and 26 to hand off to an earnings growth algorithm. That has downshifted because of three factors. One, I think investment banking activity has been slower to start the year. I think it's more of a delay and not out of the pipeline. Two, the yield curve has been a little bit more favorable than expected. And three, if we do have an employment picture that is weakening on the margin, banks will have to reserve for credit losses going forward. Now, this is not a capital issue. I think they're actually all very well capitalized. It is not a change in the earnings algorithm. I think it's more of a delay. And with the correction that you mentioned, I do think a growth scare is embedded and discounted in the stocks at this point. So I think if we do have a recession, of course, financials will be very volatile. It's inherently macro sensitive. But I do think what we really try to focus on are the best-in-class quality companies that we always look for that can continue to take share through the cycle.
So more of a resetting of expectations versus a derailment of the story so far.
Absolutely. Yep.
You mentioned 2023, very tough year for the banks. We had Silicon Valley Bank, regional banking crisis. So how are you thinking these days, today, going forward, about this regionals versus large bank story?
Yeah, that's an interesting question. I think historically regionals actually traded at a premium to big banks because I think big banks were, saddled with a lot of regulatory headwinds. And if the Fed does cut 3 times this year instead of 1 time that we were expecting at the beginning of the year, the regional banks are liability sensitive, and that should be a boost to them. So I do think there's a trade that is setting up. However, I actually think on a longer term basis, the big banks have better franchise moats, such as when they can capture and acquire a customer very young in their age. Let's say 17, you go get a debit card, you get a checking account, maybe you get a mortgage one day, you have student loans, and then you graduate to, asset and wealth management, hopefully one day estate planning, maybe you get a small business loan. So I do think these big banks have these really healthy franchise moats that can address the consumer as they age and as they grow into their wealth and their flow of money. And so I actually think going forward, if regulation does become less of a headwind, that the banks are more of an investment case, whereas regionals are more of a trade.
Very well said. You mentioned a third major subsector within the financial sector, insurance.
Yes.
What are you seeing there? What's interesting? What are headwinds?
Yes, definitely a lot that's interesting in insurance right now. It's my safest and it's my less volatile sector at this point, and insurance is acting as insurance. And we like Progressive, which is an auto insurer. By definition, auto insurance is actually non-discretionary. It's required by law to have auto insurance. And if the economy does weaken, you actually drive less, so the frequency of accidents is actually less. So their top line, their revenue base, is actually very stable and non-discretionary. Now, on their cost side, there could be some noise if tariffs does increase the cost of fixing a car. That's going to eat into Progressive margins, but it is a very short-term phenomenon because they can price 6 months out. So as long as they see the cost headwinds coming, they can go ahead and price that out in a few months. And actually, in Berkshire's annual shareholder letter, Mr. Buffett does talk about the merits of auto insurance versus some of the other longer tail liabilities.
Insurance is the insurance.
Exactly.
I love that. And we certainly all felt the increase in auto insurance and all kinds of insurance.
Yes.
This has been wonderful, very near and dear to all our hearts. Now is the time for our usual bonus question. If listeners here want to get a better understanding of what's going on in the financial space, what are some interesting trends, what's maybe a book or a news source or a podcast or show that you'd recommend?
Yeah, this is the fun part. So I do think Berkshire's annual letter is definitely a worthwhile read for anyone that's interested in history, in financials, in investing. And I actually think JP Morgan's annual shareholder letter is also really interesting because it's a microcosm of all the, healthy businesses in banking and capital markets. And I think we do a good job in terms of talking about the near term and the longer term in the annual shareholder letter. And lastly, I can't call myself a financial analyst if I have not tried and failed many times at predicting interest rate policy. And so instead of trying to predict it, I just think back to, what is the decision-making process that the Fed goes through? What tools do they really have? And how are they thinking about this situation? And the book that I love is Ben Bernanke's 21st Century Guide to Monetary Policy. It sounds really boring. It's longer than Moby Dick, but I couldn't put it down.
Some great suggestions for all types of listeners. Thank you so much, Laura. This has been so much fun.
It's been fun.
And thank you so much for listening. We've recorded several episodes with other research analysts covering utilities, semiconductors, healthcare, and much more. Thank you for listening to this very last episode of our interviews for this season. Make sure to check out our mailbag episode coming soon with myself and David Kelly.